Hi folks, this is Elliot Mehrhoff from CommodityGuide.com here to show you how to trade using a bunch of indicators, specifically, well, two indicators, but we're going to use one of the indicators on two different time frames. So the more the indicators you have, I feel, the better or the stronger the signal becomes. So first on top, I'm using a Euro Yen chart, and as you can see, I took a Fibonacci retracement from the high dating back to December 2014 to the low of, let's just call it mid-April 2015. And we drew the Fibonacci levels accordingly, and you can see all the complicated Fibonacci lines and so forth. I also, just for illustration purposes, you see all these other lines. These are moving averages and so forth. And again, all of these can be used in order to enhance your trading. But today we're going to strictly focus on Fibonacci levels and RSI, which brings us to RSI, which is on the bottom of the page, and you can see how I took RSI 9, which is a traditional count that we use RSI for, and RSI 14. So traditionally, RSI needs to be in an overbought and oversold scenario, and that generally triggers an overbought and oversold condition, which allows the market to pick tops or bottoms. People generally use somewhere between 70 and 75 as their limits, or 20 and 25 as the bottom half of the limit, 70 and 75 as the upper limits. So what I'm going to do is we're going to show, we're going to go right into this area, just going back around 6 months, and you can see how we kind of hit the upper limits on this RSI and how we're close to targeting the Fibonacci levels. Now, I don't want you to think that I'm curve fitting this. The reason why I'm not using necessarily like this one, which also shows a little bit of an overbought scenario, is because, quite frankly, it didn't have the same trade location as this one. Meaning, I would have used the same methodology that I'm about to teach you, but I wouldn't have had any trades being signaled because we didn't really hit against any Fibonacci level, as you can see. We went above the 38.2% retracement, and we didn't really hit the 50% retracement, so it didn't really give us a level to sell against. We could have used the moving average, which is right over there, but we're not really focusing on that for now. The bottom line is it did come off on the RSI. As you can see, the market over the next month or so ended up coming off, and that turned out to be a good trade. However, that didn't turn out to be a great trade location. And that's very important. And we're going to talk about trade location. We're going to talk about where to put your stop, where to take your profit, and so on. So getting back to the issue at hand, I'm going to be taking this because you can see it bounces, for illustration purposes, right off against the Fibonacci level. So let's see how to trade this particular scenario. And what I'm going to do is I'm going to blow up this particular time frame in June to make it a little bit easier for you guys to see. Okay, so as we can see, the market is trending higher in Euro Yen. The Euro Yen chart, market is trending higher. Moving averages well above. You can see I have a 20-day moving average, which is this orange line, and we have this other moving average, which is a 200-day moving average. We're well above trending higher against these moving averages. And we start to trend that much higher where we get into a situation where we become an overbought scenario. So if you take a look at my RSI levels off to the right, you see how RSI 14 on this particular day is at 71 and RSI 9 is at 76. Then you start to really get into what I would call an overbought scenario, which is RSI 14, which is 75. It's a 14-day, so it's going to take a little bit longer. And you have a 9-day RSI, which is close to 81, for argument's sake, if we want to round. And both of them would signal an overbought scenario. So now that we think that the market is overbought and the market should end up going lower, the problem is that where do we put our trade? Where do we go ahead and sell? Because as we know from experience, RSI and markets can continuously go higher. So we need a place where we say to ourselves, okay, generally speaking, the market is overbought, but it appears that right now the market is just going to keep on going. So what I would do is take the Fibonacci level. As you can see, we're going right up against that Fibonacci level of 61.8, which is right around 184. It says 140. I'm sorry, excuse me, 140.88. You can see it right here. And I would go ahead and probably leave an order at 140.85. 140.85 to sell euro yen. I don't want to leave it right at 140.88 or 140.90 because if my technical analysis is correct, I'm liable to miss the order if we get up to 140.85 and then we come off. So what I'm going to do is I'm going to leave it at 140.85. I'm also going to put, let's say, a 25-point stop loss, because I want to give myself a little bit of leeway that if the market goes up to 140.90 or 140.95, I don't necessarily want to get stopped out. I want to have it in the general vicinity of this Fibonacci retracement level. So let's take it as if we sold at 140.85, and it appears that the high on this particular day is one. And by the way, I'm sorry, but I would leave the stop at 141.10, given the 25 pip leeway. As you can see, the high here on that desk bar was 141.07. So it stays within our tolerance of where we consider ourselves wrong. And we end up closing on the day at 139.78 for argument's sake. So the important thing is that we kind of satisfy all of our requirements. We're in an overbought scenario, so we think that the general direction, we have a bias to sell euro yen. We take a 25 pip stop loss, meaning we have a 25 pip tolerance from the level of which we want to stop, the level of which is the 61.8 Fibonacci retracement at 140.88. So we're going to leave our stop right at 141.10 or 141.15. Doesn't necessarily matter. And keep in mind, in real dollar terms, we're talking about on a 100,000 euro yen position, we're talking about a little over $200 loss on this trade for the retail traders out there. But we end up closing at 139.77, and let's call it 139.80, which gives us, because remember, we sold at 140.85. At 139.80 gives us 105 pip take profit, which equates on a 100,000 euro yen position of $875. So this also satisfies our risk-reward scenario where we would stop out and lose a little over $200 yet we ended up making over 4 times that amount, close to 5 times that amount, and we made $875. So this is a very good scenario. And if I walk through and I constantly use that 140.88 or 140.85 level as my sell, as you can see here, I didn't quite get there to that 140. It looks like the high was 141.71. Because we're still in an overbought scenario. The RSI is still 9 is still over 75. And as you can see, we here again, if we ended up selling at 140.85, we didn't get there. The high was 140.76. This scenario, again, we're still in overbought scenario, but here we ended up being able to sell at 140.85 using a stop of 141.10.15. Doesn't make a difference, regardless of your whatever money management you can tolerate. And we ended up coming off all the way down to 138.95. That's close to 139. That's almost that's 185 pips profit on this. A 25 pip stop loss, 185 pip. And if you put it both together, you made 185 pips here. You've made close to, well, you made 105 pips over here, and you end up just risking on both of these trades 25 pips. You're making close to 300 pips on using 2 indicators. And as you can see afterwards, we're no longer in overbought scenario, and euro yen ends up tailing off at the end, but that's neither here nor there. I hope this shows you how to use 2 indicators and the power that 2 indicators can have if they're used simultaneously together. For those who want to see more of educational videos, please go to our website, commoditiesguy.com, or you can check me out on Twitter at Elliot M. Trader. And I got a couple of other tips for you. Please follow me, and thank you for listening.